guests, and audience to the third edition of the Proshare Economics Conference themed Navigating the Nigerian Economy and Household Realities, Policies, Programs, and Projects. This conference is expected to highlight 1. The country's macroeconomic progress and lessons learned within the last 1 year. 2. Functional government and private sector initiatives that should be scaled or replicated to boost national productivity and improve household resilience. 3. A clear understanding of the economic pressures faced by households with practical strategies for addressing same. Number 4, actionable insights on how the current economic policies can be adjusted to support Nigerian households better and promote sustainable economic growth, and collaborative imperative for policymakers, business leaders, and other stakeholders to create inclusive and impactful economic solutions for Nigeria. As usual, we would like to set the housekeeping rules to guide the conference. For all technical issues, kindly use the chat forum and direct the same to the host. All attendees' microphones are muted to prevent interference. Participants have 2 interaction points after the first round of exchanges with panelists and after the second round. You can submit questions and answer via the chat box. Decorum standards within our governance ethos are in place and will be activated even as we encourage everyone to express themselves. Finally, please do note that this conference is being recorded and live streamed on Web TV YouTube page, Proshare X, and Facebook platforms. By attending this conference, you acknowledge and agree that your participation will be recorded, including any questions or comments you contribute during the session. Proshare may use the recorded content for research, educational, or future conferences. We'll be taking our first poll right now, and we're inviting every attendee to participate in the first poll. Thank you for participating in our poll. As always, we will also have these polls done intermittently, so we urge you to participate. Thank you. Right now, please permit me to welcome the founder and chairman of Proshare, Mr. Olufemi Awoyemi, MNI, for his opening remarks.
Thank you very much, Chike. My remarks will be short and cut because of the significance of the event. A year ago, in February 23, 2024 to be precise, we convened the maiden edition of this conference under the theme Policy Crossroads, the choice between strangulation and expansion. At that time, our nations faced some critical challenges arising from a backlog of issues that we've had, and perhaps the more interesting one was the development of a crisis of confidence in both the macroeconomic and microeconomic conditions that were deteriorating. We were forced, therefore, to pause, reflect, rethink, and reimagine, and most importantly, reposition existing strategies. That required us to cut through the noise and assemble a team of distinguished entities who spoke around the issues. These panelists were carefully selected because of their knowledge and their ability to understand both the temperature and the thermometer of the economy. The panelists from that conference reached some vital conclusions. One key takeaway was the urgent need for a clear and actionable roadmap beyond party manifestos, one that would integrate both the national development plans and the medium-term expenditure frameworks into a coherent governance framework. That blueprint that we sought was meant to allow us to provide feedback to the government under a concept we believed would help for us. This was also important because there was a strong call for transitioning from a siloed operational model to a more collaborative, what we call the whole of government approach, and the whole of society approach. Importantly, since we were working on this model, we felt it was important for us to also incorporate this in our capital market report, outlook report for 2025, and our economic outlook report. Today, as we reflect on the past year, and most importantly, the dynamics of what has happened between December, January up to date, we see signs of relatively calm and some improvements in our macroeconomic indicators. However, in spite of all this, there seems to be a delicate balance between domestic challenges and external economic pressures and the outcomes therefore. Domestically, what we consider the elusive Goldilocks scenario has eluded us. Reserves have been built up and has been going on a yo-yo. What we see here is both a high and low operating at the same time. However, the economic reality for households paints a stark contrast, characterized by affordability constraints, mismatch in incomes, and expenses concerns. Most importantly, the increasing pressure on the family unit and a host of other contagions from the exposure to macroeconomic risk has made the household not a partner in the recovery in the economy. At a time when our external economic environment also remains volatile with distortions in trade and foreign markets, the calibration of our foreign market policies and external economic strategies has never been more critical. Today, given this backdrop, we are hoping that we will focus on navigating the Nigerian economy and household realities by taking a look at the policies, programs, and projects that we have in place with a view to addressing one or two major things. What have we learned from our first year of our recovery phase? What do we need to do? And this is very significant that this is happening ahead of the central bank's positioning. So the topic today is premised on our conviction that the obstacle is the way. It is not a limitation to us, and we should confront it. So as we delve into this crucial topic, I urge us all to look beyond the immediate challenges and question conventional wisdom, especially for our participants, so that we can help reshape the narratives and offer actionable guidance that can watch our recovery and nourish the path towards prosperity. As we said in 2024, when smart people are stuck, they ask for help. It is not that these people cannot find a solution, it is that they cannot see the problem. Well, today we have assembled a team of distinguished economists and professionals who should be able to offer us insightful outcomes that will emerge, therefore, their conversation. On that note, I say thank you and welcome. God bless.
Thank you very much, Chairman, for your insightful remarks. My name is Oto Abasi-Abasekong, and I'm the head of news at Proshare. I'll be moderating the panel session for the conference. Before we go further, I would like to invite all our participants to our second poll. Thank you for participating, and we will now proceed to our panel discourse. At the maiden edition of the Proshare Economists Conference, key recommendations were made that could lead the Nigerian economy towards stability. Some of the recommendations include tackling Nigeria's challenges in policy silos has been ineffective, thus building a whole-of-government approach to governance would provide context to policy actions and a coordinated governance strategy, which was earlier stated by our chairman in his opening remarks. The government's fiscal policy drive has emphasized the income statement. There is an opportunity to unlock revenue from the country's balance sheet by leveraging assets. The Ministry of Finance incorporated enumeration and valuation of the country's assets will hasten the process. And finally, the exchange rate crisis has proven to be a supply-side challenge, and the currency depreciation creates an opportunity to improve non-oil exports if the HS code is reviewed. Joining me for the panel discourse today are Dr. Ayo Teriba, CEO of Economic Associates, Dr. Tilewa Adebajo, CEO of the CFG Advisory, Dr. Ogho Okiti, CEO of ThinkBusiness Africa, and Mr. Teslim Shitta-Bey, Director of Research and Chief Economist, Proshare. It is interesting that for this panel discourse, 3 of our discussants featured at the maiden edition of the Economist Conference. We believe this will be a broader conversation on the state of the economy and a pathway for households. Once again, I welcome our distinguished panelists. For the first round of questions, let me begin with you, Dr. Ogho Okiti. Since the last conference and ahead of the first Central Bank of Nigeria Monetary Policy Committee meeting scheduled for this week, Wednesday, 19th, what key lessons have emerged from Nigeria's economic management, particularly regarding fiscal discipline and monetary policy? What specific policy and program adjustments are necessary to address current gaps and mitigate the adverse impacts of policy reforms on households, which we believe are the common denominator in our economy? Over to you, Dr. Ogho Okiti.
Yeah, thank you so very much, Otto Habasi, and thank you for inviting me here again. So, when we talk about policy, I think there are 2 major policies that have happened in the last nearly 24 months under President Bola Ahmed Tinubu, and of course, that is the removal of fuel subsidy, and the second one is the alignment of the exchange rate. Those 2 reforms or policies in themselves show that the government wanted to pursue what I call a market-led economy. And that is good. Remove distortions. One is a basic micro, which is fantastic, which is the removal of fuel subsidy. The expectation is that following that removal of fuel subsidy, over time, we will see the investment in that sector, not only in the refineries, but also in associated industries. And that is my expectation. So not only a pass mark, more than a pass mark, is the removal of such. That policy for me is the best thing that has happened to Nigeria in a long time. The second one, which is the removal of distortions in terms of the exchange rate, that is also good. But I want to take you back, especially because today we are focusing on household. The context in which those policies were done, especially the removal of fuel subsidy, is that, especially for those of us that argued for those removal, we said that the resources will be used to pay down government's debt. We said that the resources will be used for education. We said that the resources will be used for infrastructure. And we said that the resources will be used for health. So meaning that when you have the kind of shift that we have had because of the removal of subsidy from the private sector to the government, we expect the outcomes, or at least we should begin to see the effect on education, infrastructure, and health, or the reduction, or at least a static debt level on the government side. If you look at the statistics, especially looking at the fact statistics, yes, even though not taking into consideration the rate of inflation, you will see that the average increase in the revenues to the government side through fact has been a minimum of 50%, about 50% on average. However, on the household and on the household side of things, things are getting worse. So when people ask me and say, oh, the reforms is what is causing all this problem. No, the reforms are not bad in themselves. What has happened is that the government has largely pursued policies that are contrary to the objectives of the reforms. So prudence was required, and we have not got that prudence. So whether it's in relation to inflation, whether it's in relation to removing of market frictions, whether it's in relation to worsening market inefficiency in Nigeria, everything comes from the fact that the reforms that we have undertaken as the revenue that came from those reforms have not been used to facilitate private investment in the way that I believe most of us that argued for the removal of fuel subsidy, I think in the way that we imagine it. So, I mean, that is the broader context in relation to the policy and, of course, in relation to the household, the effects on household that we have seen in the last 18 months. Thank you.
Of the fuel subsidy and, well, the distortions in the exchange rate market was very important. But what we face as a challenge, as you highlighted, is the need to facilitate private investments to those resources that were derived from the removal of the subsidies in these two spaces. And so that's very important to look at prudence in terms of the policy framework of government. We'll get back to you on our second round. But to you, Dr. Adebajo, at the last conference, you stated that monetary policy is currently loose, fiscal policy is challenged, and needs to be tightened, including prioritizing trade and investment policy. How does this feed into your recent report on high interest rate spread on the Nigerian economy, which you wrote with Mr. Mustafa Chikobi, chairman of the Bank Directors Association of Nigeria, on the adverse effects of high interest rates on the economy? And what are your recommendations now on monetary policy tightening?
Thank you very much, and good morning to my fellow panelists, the Proshare team, and of course all the participants. Thank you for the invitation again this year. Last year, by the time we were speaking this time last year, you remember that the economy was in free fall. Exchange rates were very volatile. We hadn't had a monetary policy committee meeting. The incoming central bank governor had not had his first meeting and postponed the MPC meeting. And we had a lot of confusion with the so-called subsidy removal. And you could see a lot of price spiraling and inflation was going up. So there wasn't really any monetary policy for a long time, for about since before the last administration. There hadn't been an MPC meeting. So it left a lot of uncertainty in the markets. And I think it was at that point in time we had called for tightening. Since then, I think we had seen close to a 1,000 basis points increase in the MPC, going from 18%, and inflation had gone then from 18% to 34%. So I think those were the things that we looked at that point in time. So I think at this point in time, I think we have at least achieved some relative stability in tightening. I think CRR has increased from about 35% to 50%, which is pretty significant. NPR has gone up significantly, as I mentioned earlier. So there's been a lot of effort in the last 1 year to make the corrections in monetary policy. And now I think we are now, because of the inconsistencies and the way and manner the fuel subsidy was removed, which was in a very unstructured manner. I think, we had an increase, so many increases, but right now, I think today we are finally settled with where the fuel price should be. So the cost push factors that were driving inflation then, I think, is now abating. And I think we are now all expecting that the trajectory on monetary policy should be downwards. As you know, the central bank set an inflation target of 24% for last year, but could not meet that inflation target. Inflation was supposed to be 24. It's now currently 34. So hopefully, let's see what happens with the rebasing of the CPI and how the monetary policy authorities will react in their meeting in the next couple of days, because I think there's also the challenge of tightening and the issue of how it's going to stall growth. So things have changed significantly in 1 year. So what we're expecting now is a downward trajectory on inflation, and hopefully we can begin to grow the economy. But unfortunately, from what Dr. Okiti said, the savings that we have made from subsidy removal, the $10 billion or so plus, we're now using for debt service, which is rather unfortunate. Thank you.
It's very clear. You agree with Dr. Okiti that we've not really leveraged the resources garnered from the removal of the subsidies in fuel and, of course, the exchange rate. But if you said that in looking at 1 year now, from the conference, we've seen that the cost push factors are abating, and also that we're beginning to see the trajectory of inflation going downwards. And of course, all eyes will be on the Monetary Policy Committee meeting this week. But very clearly, there's a need for more synergy in policy. Thank you very much, Dr. Adebajo, for your opening thoughts. And now get to Mr. Shitta-Bey. Mr. Shitta-Bey, a significant consensus from the last conference was that a fiscal framework is required to ensure policy sequencing, policy impact analysis, timely intervention, and documented policy goal and process track. Do you think this is being done at the moment, and what advocacy or nudging is necessary to get policymakers to act on this?
Thank you very much, Otto. I'm one of the few people on the call today who you can't quote said something at the last session. That could be an advantage or a disadvantage. But let me just start this way. In the beginning, there was the household. The whole concept of economics rests on the household. How the household thrives, how it allocates resources, and how it's able to sustain itself from one economic cycle to the other. So that's why economics it started from the Greek word, economia, the household management. How do you manage the household? Now we have extended in modern times that to the concept of how do we manage the state? How do we manage institutions of state? Two aspects come clearly here. There are the monetary aspects and there are the fiscal aspects of managing an economy. And there's also the budgetary aspect. Now, you asked me about fiscal framework. The fiscal framework in Nigeria hitherto have been rather fragmented, untargeted. But we have gradually started to address those issues. However, they could be addressed in a much better manner. Let me put it in this context. If you look at small and medium-scale enterprises, in fact, nano enterprises, they are all under severe pressure under the current arrangement. One of the ways these issues have been addressed is by transfers, cash transfer arrangements. Now, these cash transfer arrangements are bad, but they're only problem. They're only part of the solution to a problem. The World Bank recently at a conference, a monetary policy forum in Abuja, commended the government on cash transfers. While we share in Proshare the concept of cash transfers, however, the concept of the cash transfer does not substitute for the concept of improved productivity. Rather than give households fish, we believe that households should be taught how to fish. They should be given the opportunities and incentives that are required to enable them build businesses, build their own incomes, rather than hand them down incomes and create a dependency, a nation of people who are dependent on fiscal resources. Nigerians are too geared towards productivity, they're too determined to excel as individuals that we should reach a level where we're giving them handouts. We believe that a superior fiscal arrangement will enable households improve their livelihoods through productive activity. Incentive structure need to be improved. We also believe that monetary policy arrangements need to be refined. Now, these are just my early shots, but I'm going to say something quickly here. One of the things we have been advocating consistently at Proshare is that we have a system whereby we financialize public assets. Now, what does that do? That stimulates a situation where we can create value within the system. That value can trickle down to households. Let me just give a quick example here. Let's assume, for example, we took the National Stadium Surulere and we decided to financialize it. What we mean by that is that we allow private sector investors to come into the National Stadium. For instance, we give them a 20-year franchise or lease on that stadium. And once we do that, we say that, okay, we've given you 20 years, do something with this. Now, it's most likely that those who take over the stadium are going to look for the best ways of recovering their money. And that will involve maybe creating activities around the stadium. Now, these activities will lead to supply of food, for instance, because the stadium will be active. So you see food chains linking to that environment. We'll see people who will also actually provide other services for that environment. We need to find the appropriate linkages between the macro and the micro. That hasn't happened so far. We need to improve the macro and keep an eye on the microeconomic activities, the household economic activities. Dr. Okiti, I think it was, who mentioned the fact that there have been unintended consequences of the removal of fuel subsidy. There have been unintended consequences of harmonization of the exchange rate. In and of themselves, these policies are not bad. However, they have compromised the sustainability and stability of household economies. And that is an issue we need to take very seriously. I think I'll stop at that for now.
Very, very clear insights you've given in your opening statements. The need to link macro economic policies with the micro, and the households remain very important. And you gave a very good example of the need to move from a cash transfer setup to where policies can incentivize investments in improving the livelihoods of households, from businesses to enabling environments for the citizens. Very clear insights. You also talked about financializing public assets. And of course, I'm going to Dr. Teriba, who of course is a major proponent of that. Dr. Teriba, you have been a proponent of building our foreign reserves by attracting foreign direct investments to stabilize the naira with concepts like financializing our public assets. What is your current approach to our fiscal monetary policy management? Have they delivered worthy outcomes? And how can we improve them, particularly as the Monetary Policy Committee first meeting for the year kicks off in a few days?
Thank you very much, Otto. Good morning, everyone. And I thank the chairman of Proshare for this initiative. It was good to have brought us together last year on the eve of the meeting of the Monetary Policy Committee, and even more thoughtful to bring us together again on the eve of their first anniversary. And it's good to see Dr. Okiti. It's good to see Tilewa again. We were 3 out of the 5 panelists at that maiden edition. And it's nice to welcome Teslim to the panel. Good morning, ladies and gentlemen. My pleasure to respond to Otto's statement. He has mentioned reserves, he has mentioned fiscal policy, he has mentioned monetary policy. And on this tripod stands the macroeconomic policy. We get to say a lot about fiscal policy. We even have a committee that looks after monetary policy. And we get to say nothing about investment policy that can bring the reserves in. And in the last 1 decade, investment policy had become the preeminent policy instrument for pushing countries forward. Trade policies have lost the bite that they once had. Industrial policies have lost the bite that they once had. And you can see, regions that benefited from trade and industrial policies in the past now stagnating, notably the Euro area and Japan. And you can see countries that gets investment policy right advancing quite rapidly. Example, India or Saudi Arabia. So Nigeria says very little about investment policy. You've alluded to some of the calls I've made. Trade and industrial policy focuses on income statement, on production, while investment policy focuses on assets, foreign direct investment, domestic direct investment, which is the primary global source now of getting liquidity. Our macroeconomic, the number one problem that we need to solve on our macroeconomic front is to get reserves up to adequate levels. Government met 33 billion a year ago, and the president has recently quoted 42 billion. Yeah, but when we were talking 33 billion, JP Morgan came out and said that 33 billion was gross, that net was just 3.7 billion. So now that we're talking 42 billion, if that is gross, what is net? At the end of the day, and the central bank did promise at the IMF annual meetings that by January, the net figure will be published. It hasn't. So unless you get that reserve underpinning of monetary policy right, in other words, exchange rate stability is predicated on reserve adequacy. You can be happy that over the past 1 month, the Naira has stabilized or even strengthened. But that's after the Christmas binge, after the end of the year spending, the lull that follows the festivities. And when activities begin to pick up in April, as they did last year, as of April last year, the exchange rate had firmed up from 1.9 to 1.3. And it was to give way, as the activities picked up. So where do we stand? Monetary Policy Committee meeting this week. How prepared are they to ensure that tightening will actually provide the stability that it largely failed to produce? Last year, they tightened so much. To achieve stability, inflation is even worse than it was before they started tightening. Somebody was quoting the IMF as saying that they mitigated, it could have been worse. We are not here about it could have been worse. At the eve of the meeting, the central bank was telling us that inflation will be 21% in December. And therefore, they tightened. So don't come and tell us that, what you delivered was that it could have been 50% if you didn't tighten. Right? You tightened to get also 21%. So let's get that conversation very right. I don't think that I said so last year, and I will say so again this year, that tightening will be futile if we don't pay attention to reserve adequacy. And we are putting banks under pressure to meet capital recapitalization deadlines. We are not putting ourselves as a country under any pressure to meet any reserve rebuilding deadlines. And we are quiet on industrial on investment policy. We should say more on investment policy. Yes, talking about Finance Act, which seems to tax the income statement. They are saying nothing about Investment Act. And every country that has progressed in the past 1 decade has done so by getting more investment, by getting, its investment policy in focus. And Nigeria needs to follow suit. You have MOFI, the MOFI list the assets and begin to take them to the market, to value them, and we're not saying sell any of the assets. Aramco wasn't sold by Saudi, but they did an IPO, a minimum IPO 2%. So we're not saying sell assets, we're saying establish their market value and raise liquidity against them. For fiscal policy, as I close, we have a challenge. People say that monetary policy is tightening, fiscal policy is loose. And I will caution, that at the end of the day, fiscal policy is about what happens is not about what was announced. Because this year now, the government is announcing 55 trillion in spending. But last year, in spite of supplementary approvals that brought total planned expenditure to 35 trillion, they did not actually find 25 trillion to spend last year. The National Assembly is telling us that the budget performance was 50% or less. Meanwhile, that we know about that in December, or we know about that in January, whereas Central Bank had held 6 meetings in which they have presumed that the announcement was reality, and they have tightened based on that threat from fiscal expansion. Only for us to hear, at the end of the year that they didn't find the money. Are they going to find 55 trillion to spend in 2020? I doubt it. So we should help, the fiscal authorities, to move more towards credibility, to move themselves more towards we being ready to take whatever they say on face value. But right now, you need to have a discount factor in mind when you hear about what budget has been approved. Last year, the discount factor, reasonable discount factor, was at least 50%. So for 2025, what's that discount factor going to be? And we should have conversations like that so that the central bank doesn't just keep heaping, hardship on businesses and households out of an exaggerated fear of what's coming from the fiscal end that will eventually not come. I would like to punctuate, my comments here. Thank you very much for the opportunity.
Issues. Of course, you've said that there's need for us to know what is the current value of our net foreign reserve, not the gross. The need for us to have reserve adequacy, which is very critical to achieving exchange rate stability. One that I really conform with is the investment policy. We need to get it on track. And of course, fiscal policy, like you rightly said, having a budget is one thing, but the realistic way of funding that budget, which of course again goes to unlocking liquidity from assets. Thank you very much, Dr. Teriba. And that's wrapping the first round of questions. Very, very insightful thoughts from our panelists, and we'll go to the second round. And of course, we'll begin again with Dr. Okiti. Dr. Okiti, last year you proposed 4 options to achieving stability: savings to close leakages, concessions and asset sales, borrowing to build reserves, and addressing our power sector issues. What is your assessment of the progress being made on the roadmap, and what impacts have these reforms had on growth and key sectors of the economy?
Yeah, thank you so much, Otto Abasi, and thank you to all the other speakers that have spoken very profoundly about where we are. So, yes, I spoke. So let me try and dimension this way. When we talk about reserves, the main purpose of the reserve is because your level of reserves serves as the anchor for 2 things. One, anchor for exchange rate stability, which Dr. Teriba explained. Then second, it serves as the anchor, or I call it insurance, for the attraction of foreign direct investment, because without the expectation of some sort of stability, you will not see that foreign direct investment. Yeah, but if you permit me, I really want to move away from all these macro issues, not because they are not important, but because I'm beginning to think that if we continue to talk about all these macro issues, we tend to leave the important side of things. So we are talking to probably like 500,000 people, in my own opinion, when we talk about macro issues. It affects the others, but in terms of the understanding of the macro issue, probably talking about 500 to 1 million people in Nigeria today. So can we go back to some context? Because Now the government has released another budget. They released a budget last year. There was a budget 2 years ago. There was a budget 3 years ago. There was a budget 4 years ago. And I'm beginning to think, what is actually going on? What is the purpose of this budget? What is actually our economic development strategy? So whether you look at it from the point of power, it was just these last 2-3 days, I was looking at power. I said, look, hang on a minute. We started this democracy business 26 years ago. 26 years ago. And today we are still on 4,000 megawatts. 4,000 megawatts. But in those 26 years, you have government officials buying cars. There's nothing wrong with buying cars, but there's urgency about buying cars. There's urgency about building vice president houses. There's urgency about buying yachts. There's urgency about buying jets. There's urgency. And I'm like, should it not be, in my own opinion, I'm talking from the business perspective, when you talk to business people today, there are 3 major or 4 constraints to productivity growth and to business growth in Nigeria today. Yes, you have the exchange rate stability. Thank God there's some improvement in the last few months on that, but as Dr. Teriba said, the risks ahead are still there. So you have exchange rate stability. Second, they will tell you infrastructure. Third, they will tell you insecurity. Fourth, I usually had this fourth, the quality of the people. The quality, the average Nigerian is anyone, even if you have 1,000 people, 2,000 people, either watching this program now or we watch it later, they are not the average Nigerians. So what is happening to the Nigerians in Jigawa, the Nigerians in Ekiti, the Nigerians in Unewi? What are the things? What is the plan for those Nigerians? What is the plan for their education? What is the plan for their health care? What is the plan? You know, this is not about the federal government alone. Obviously, it's not. But the point I'm trying to make here is, if we don't get the structure to deliver right, then we will hear about is just expenditure numbers, and there'll be nothing on outcomes. Our life expectancy is not improving, but we have Minister of Health. Our education outcomes is not improving, but we are changing the system every 3 years. So now it is now 12 this, whatever. But nobody is talking about how do we improve the quality of education. I was talking to a teacher in a public school this last week, and I was shocked. The teacher told me that because they get some foreign funding for some public schools in Lagos, that because of that, the principals who are held responsible for progress in public education are forcing them to write exams for the children. So, in other words, the children are not making progress, but the metrics are improving. So, I spoke about these 4 issues. Yes, quite all right. But in my own opinion, there's probably only one I want to talk about in that. Why is this so difficult? We had a privatization of the power business. Has it worked? It has not worked. Why is it so difficult to say, oh, in the next 2-3 years, we want to correct what the problem is and deliver power to Nigerians? I don't know about your business. I run just a very small business. The number of my staff, they are not even up to 10. However, I have noticed that our productivity has fallen. Why? Because of the cost of transportation. The cost of transportation. Productivity has fallen. So many people are now doing 2 or 3 days from home. But you know what happens at home. Nobody works from home because they don't have power. So you are just paying salary for people to sit down at home. So these are the issues with businesses. These are the issues with household. Are we going to deal with them, or we are just going to be shouting budget figures, 54 trillion, 54 trillion? 54 trillion means nothing to the average Nigerian. what is the outcome of all this expenditure? And I think it's about time that fiscal policy is the problem. I understand that we may want to be talking about monetary policy, but I have never seen monetary policy as a problem in Nigeria, because all our problems can be traced to faulty fiscal policy. And that is, if you extend the household budget constraint, or you extend the business budget constraint, and you extend it to the national, it comes down to one simple question: how do you spend the 1 naira that you have? It's not how you spend the one that you have not earned, but the 1 naira that you have, the 1 naira in the hand of government in Nigeria, how is that spent? Thank you.
The macro is one thing. Okiti, you also said that monetary policy, yes, is okay, but we need to address issues around the faulty model of our fiscal policy framework. Let me get to you, Dr. Adebajo. Also last year, you emphasized the need for fiscal tightening, curtailing government spending, and implementing the Professor Stephen Orosanye report to streamline governance costs. Have these recommendations been applied? Where they have not, what have been the consequences, and how can we move forward to ensure the effective implementation?
Thank you very much. Well, just a follow-up in terms of where we are now, in terms of the monetary policy and the exchange rates. You talked about the high interest rate spreads. I think it's important for us to understand what we have not done in Nigeria is to understand what is the position of our equilibrium or attaining political stability to ensure growth and development. Over the last 10 years, I think if you take a look at the economic growth, the economy grew by about 6% maybe in 2015. And maybe in 2021, we saw 5% after coming out of a recession. But on average, I think our economy in the last 10 years has grown sub 4%. And we've had an area of high inflation and unemployment. So we have not been able to break that stagflation problem in Nigeria over the last 10 years and set the economy on a path of sustained growth and development. And I think it begins to impact a lot of things. We tend to be fighting fires. And I think that is what tends to happen now when you talk about high interest rate spreads. The government, as you said, is looking at inflation is coming through because of exchange rate devaluation and the pass-throughs into importation, and also the cost push factors from the removal of the subsidies. Inflation is now 34%. So we just tend to be fighting fires. So at a point in time when you have that, then you find a situation where, your economy is at an imbalance, you're fighting all kinds of fires here and there, and we do not have a point of stability that we can have sustainable growth. Take a look at what happened in the US when inflation hit about 8 to 9%. It took the Fed 2 years to bring the inflation down to levels where they felt they were going to begin to cut rates to their inflation targeting. It's a process. But in Nigeria, we don't seem to have a coordinated approach to how things are working out. And for me, that is really where they have the challenge. Because if you do not coordinate and understand that there's a cause and effect to one thing or the other, Ayo Teriba is talking about investments. Yeah, but if the investment climate is not right, how are you going to attract FDIs? The stock market, for instance, made significant returns in Naira at about 37%, but from a dollar perspective, the returns were negative, like 25%. So how do you attract investments in that area when your investment climate is not right? A lot of people who invested in Nigeria in dollars because of the devaluation, who brought in their money at 200, by the time the dollar went to 1,500 now, most of them are going to take a massive loss on those investments. So there consequences to instability within the system. So when you talk about high interest rate spreads, you are seeing how things are working. Government in itself is causing a problem, not because of what they're doing, because if you take a look at the government budget as a percentage of GDP, probably it's 10% of GDP, maybe less than that. So if you take a look at the government expenditure, what are we really looking for in government expenditure? Well, yes, government pays its salaries to its households in terms of recurrent. So the households will probably boost consumer spending and, to try to see how that can boost the economy. But overall, what we're looking for in a government budget, it is investment in infrastructure, it's capital budgets. And I think like Ayo Teriba has said, you make a big budget, but at the end of the day, you are not financing, you are not able to even meet the financing targets. The only targets you are exceeding are your debt targets. If you take a look at the budget now over the last 3 years, the deficits, accumulated deficits over the last 3 years is close to 36 trillion. And right now, with this increase they're talking about, you have a 13 trillion deficit that you are looking at this year. You add to that. So it's what the government is doing really is the debt issue is what it's doing. And they're using debt really now to finance recurring expenditure, which is a challenge. So even if you're looking at the budget being at 50%, the capital budget is probably about 35%. And that is really what we look for in government expenditure to be able to help to provide the proper infrastructure that will help the business environment, that will help growth, that will help development, and eventually help foreign direct investments. But if you take a look at the investment climate now, while the naira to the dollar might look cheap, a lot of people that have lost money in the past are still reeling from that. And foreign direct investment last year was less than $100 million. The biggest project we have in Nigeria now is LNG Train 7, which is an $8 billion investment that was announced 3 years ago. I think that project is due to be completed this year. But if you look around you, then what are the next projects that are going on? But I think the silver lining is the fact that a lot of the changes and the approvals that government has given to divestments in the oil sector, I think will begin to yield results. So if government can continue along those lines, then at least oil is selling at $70 a barrel and we cannot meet our production targets. So if in the list what we do is to at least boost oil production to be able to get back to 2 million barrels a day, in excess of that, then at least revenues can begin to come into government coffers. We can begin to have more foreign exchange, and hopefully that can stabilize the economy and help erase the government deficit. But as it is now, our current liabilities exceed our current assets. So there's insolvency in government, and government has no choice right now but to sell down assets. And I think I've recommended that if they sell down all the JV assets, they could raise anywhere between 30 to 50 billion US dollars, which they could use to, restructure their balance sheet, pay down the debt, and of course, there are other assets in MOFI also that we can use. So there's time for us to begin to optimize equity within the government's balance sheet because debt is no longer viable. And to reinforce that on this budget for this year, the debt service is about 16 trillion. So if you take a look at defense, health, education, infrastructure, those 4 critical sectors, the total budget for that is 14 trillion, but debt service is 16.3 trillion. So therein lies the problem of the government.
Thank you very much, Dr. Adebajo. Very clear that as a country, we need to break out from the stagflation issue. We need a coordinated approach in policy. And of course, our deficit or our debt level is not sustainable. So we need to restructure our balance sheet. And of course, you've said that there's a silver lining with the current approvals in the oil and gas sector divestments. But also we have an option to sell down our JV assets and of course unlock liquidity there. We talked of the range of 30 to 50 billion dollars. These are steps that we anticipate fiscal policy will look at. But thank you once again, Dr. Adebajo, for your insights. Now to Mr. Shitta-Bey, how do you think households, again, we've highlighted them as the common denominator of our economy, can better be protected in the ongoing transition phase of the economy as we look at the reforms and all the challenges that follow them?
Thank you, Otto. I'd like to thank my fellow discussants for their very insightful analysis. I would like to take a bit of a different route from Dr. Okiti when he talked about the emphasis of macroeconomic policy overshadowing that of microeconomic policy and household development. I actually think that macro and micro need to work together because one leads to the other, and the impact is actually a reverse flow impact. Now, let me give you an instance. Dr. Teriba talked about investment. Now, if we can attract those investments will trickle down into the improvement of incomes of these households. That's number one. Number two, for instance, he talked about electricity. Now, proper investment in that sector of electricity will ensure greater stability in electricity supply, and over time, a reduction in per unit cost of electricity. So it also impacts the household. So appropriate macroeconomic policies also have either unintended or intended impact on micro or family economies. And therefore, I think the macro is very important. Also, when you looked at what Dr. Tilewa talked about when he was talking about the interest rate spreads and the impact those interest rate spreads were having on the economy, interest rates also affect small-scale businesses. Businesses tend to borrow money at very high interest rates currently. SMEs are borrowing they're borrowing money at costs that are north of 30% per annum. As a matter of fact, I'm aware of some that actually go as far as 50% per annum. When you analyze their interest rates, it goes as high as 50%. Now, if we can create an environment where we have greater amount of liquidity that is non-inflationary, in other words, the liquidity is backed by productivity, we'll gradually begin to see that the interest rates charged for small and medium-scale businesses, even nano businesses, will reduce. And that will improve the welfare of the household. So it is important that we get the macroeconomics right. That being said, when you talked about protection of the small-scale businesses and households, for me, I think that the basic protection that is required is for us to get our macroeconomic indicators right, let them move in the right direction, and gradually we begin to protect these households. Because like I said before, we're not trying to build a nation of feeding bottle enterprises. We don't want to create a nation of huge amount of dependency on the federal or other subnational institutions. What we do want to do is to create a nation where we incentivize small-scale businesses and households to be able to be productive. Now, to be productive, they require infrastructure. Dr. Teriba has talked about investment, and that's for me a very critical aspect of our gross domestic product. There's an underlying weakness in attracting the kind of investments required to assist micro enterprises to grow at a faster pace. Dr. Teriba talked about foreign exchange. That is crucial. Even at the micro level, somebody says, how does foreign exchange impact agriculture? Why should Ewedu or Ugu be affected by foreign exchange? It is affected by foreign exchange. If the farmer, for instance, has to buy imported fertilizer, of course, it will impact him. And don't forget, the food the farmer himself sells, he uses it to buy other goods that are not necessarily food related. And those food prices have gone up. So the farmer will have to adjust his price to be able to cover his own individual expenses or household expenses. So foreign exchange is crucial. We need to get to the point where we can generate foreign exchange. I was also interested in the argument about the huge budget size. The problem is not so much the budget size, it's the budget funding. how do we fund the budget? The panelists here have made some brilliant suggestions. One that Proshare has very much advanced. The federal government, the state governments have assets, idle assets, some of them active assets, that can actually be financialized. Now, Dr. Teriba emphasized, we're not saying that you should sell the assets. What we are saying is that you can provide licenses, you can provide opportunities for businesses to come in and invest. And we saw that in the telecommunications sector, in a very interesting book that was written by Professor, I think it's Christensen, yes, and Ojomo, The Prosperity Paradox. They emphasized the Nigerian magic that occurred in between 1999 and 2000 when we privatized the telecommunications sector. The government didn't spend any money there. The government actually made close to $1 billion from the get-go. It got almost $1 billion. And what it just did was to offer licenses. The private sector came in and invested. Now, see how investments work. Today, as we walk around the streets, we see people under canopies selling recharge cards. If they're not selling recharge cards, they're selling telephone accessories. If they're selling all kinds of things related to that industry, small scale, this affects the household. So if you get the big businesses right and you provide the right incentives, you can generate the stream of activities that will have significant impact on households. And therefore, you will reduce the need for cash transfers. We're not saying that cash transfers are not needed. We're not saying that at all. But what we are saying is that beyond cash transfers, a more sustainable model will be a situation where you incentivize small-scale businesses. They should have access to regular power supply, have access to good roads. I'll give an example for the road. Between Benue State and, for instance, I think it was Ondo, you have 70 different checkpoints. At each checkpoint, you have to pay a toll. That does two things. First, it increases the cost of food from farm gates to the city gate. Number two, it creates a situation where you have a lot of agricultural wastage because most of these goods are perishable. So if you had a better infrastructural system where we can move goods, for instance, by rail, for example, we invest heavily in rail infrastructure, move a lot of goods by rail, so they perhaps could avoid some of the road challenges on the road, we'll be able to deliver better quality agricultural produce at lower prices, and that will protect the farm household against the intervention of the middlemen. Most of Nigeria's money in the agricultural sector is made by the middleman. And therefore, the primary farmer gets very little for his productivity, and that serves as a disincentive to continue to produce. And that's why I'm saying that what we need to do is bring in the investment. It does not have to be, and I repeat this point, it does not have to be government spending money in those sectors. All it requires is rethinking the model of those sectors such that private sector are incentivized to come into the sector. And that's, for me, is a way of protecting the average Nigerian household. Let's go by way of incentives. In some instances, we might need to privatize. I must say that. Government, in certain areas, government has no business in being in those businesses in the first place. So yes, we may privatize. That's a bit of a difference from Dr. Teriba, where, yes, I agree with him totally, where he said that we don't need to sell. But I think that there may be some instances where we may need to sell, and we should do that. And we should just get out of the way, allow private sector to do their thing, and generate the necessary inflows that we're expecting, both in terms of foreign exchange and in terms of infrastructural development. Thank you very much, Otto.
Thank you very much, Mr. Shitta-Bey. You've highlighted the need for linkage between macro and micro. Now passed by National Assembly, approximately 55 trillion, but how is it going to be funded? Very important, unlocking our assets. And of course, you highlighted a very fundamental issue, infrastructure. Just imagine if we can address our infrastructure issues, it will go a long way to address the issues of productivity in the agri sector post harvest impact. And very, very, very fundamental things you've raised. You agree a lot with Dr. Teriba, so I won't go further than that because, of course, Dr. Teriba is the next person. Dr. Teriba, a lot has been said about unlocking value for our assets, which, of course, you've continued to be a major proponent. And you've emphasized the need for us to shift from income statements to balance sheets so that we can begin to boost our reserve adequacy. Analysts are beginning to agree with this and align with this. And it is quite remarkable that it's gathering momentum. But what lesson has the current rising debt profile, as at third quarter 2024, it was about 142 trillion naira. What has it taught us about the need to consider alternative approaches such as asset centrism, which you're also a major proponent of? And where are we on this? When you look at the federal government, and not just federal government, states, are you seeing that positive moves? I've seen some states mention that they're beginning to look at the value of their assets. You've even talked about the need of asset registers. Are you seeing some good examples and some further insights on how we can take practical steps to achieve this, to address our fiscal challenges?
All right. Thank you very much. And following the very useful and thought-provoking contributions, by Tilewa, Dr. Okiti, and Teslim. In particular, some of the points made by Tilewa, I would like to provide a rejoinder on. He made the important point, that over the last year, I thought he mentioned a figure as low as $100 million came in as FDI. That how would one expect foreign investment to come in the prevailing economic climate? And this meeting with some consensus about, they say that he that does not read has no advantage over the one that cannot read. So if you are literate, but you don't read, you are not better than the literate who cannot read. So what is it that Nigeria can do but does not do, as opposed to what Nigeria cannot do? In talking about attracting investment, the investment climate is not the primary consideration for an investor. Investors are not risk avoiders. Investors are risk takers. And as long as the return is higher than the risk, they will invest. So we are discussing about attracting FDI in vacuum. When Nigeria offered the world LNG project in 1994, the money came for 2 trains. It was 4 billion, government contributed half, joint venture partners contributed half. It was the worst time in Nigeria's macroeconomy history. Inflation in 1994 was 57%, and in 1995 it was 73%. It's the worst period for inflation in post-independence Nigeria. Investors committed because it's about risk and returns. So the question that you will address to the Tinubu regime, where is the investment opportunity? What are you presenting investors to come and invest in? There's nothing on the table. And we travel around the world looking for investment, looking for investors, but there are no deals proposed on the table. You won't find investment, even after country after country has expressed desire to invest. As long as you are not giving them the opportunity, nothing will happen. Rail provides big, huge opportunity. Brazil, as we speak, has 27 privately funded rail projects in a sector where you can't even sell when you say sell the assets. Government must always own rail tracks. So it's long-term financing, build and transfer kind of arrangement. The US also has rail projects being done by private sector, Virgin Trade, in return for development of adjacent properties. So what opportunity is Nigeria offering? The grid is too small. Are you offering the national grid? Are you offering investors to come and put money in the national? They will look at the risk and return analysis, and then on that basis, they will invest. So investment climate is secondary. You're talking of size of investment that once they arrive, they can change the narrative of the business climate. So basically, I thought we should do more. We never make investors offers. Since we have done the GSM, we have done the LNG, and we did the pension. Let's encourage the current regime. Murphy has a list. Why are you hiding the list under the table? All of the countries that are getting investment right now have a platform. In Saudi, 200 projects. In India, 15,000 projects. In Brazil, 10,000 projects. And the investors are putting money in them. You can't say that some of these countries are not even more risky, than Nigeria. So basically, that's the first point I thought we should all, consider, whether we should put the cart before the horse. We should be talking about investment climate without talking about actual investment opportunity. And that's where the capital budget comes in. Many of the projects that government is making big allocations on and they can't fund should be left to investors to fund. The superhighway and the rest of that. 75% capital budget implementation, and you keep saying you want to do this project, you want to fund them, FEC after FEC, you keep approving capital projects, which you won't have the money to fund. Let investors fund the capital project. And that's the only way you can reduce these costs, going forward, by not borrowing to do capital projects, but by letting investors take equity positions. I still think that we shouldn't encourage the government to sell. I do not think that our democratic practice is mature enough, to begin to tell them to sell government assets. A lot of conflicts will arise, and people will simply transfer these assets to themselves, as we've seen, in many cases of previous privatization. The telecom sector was an exception because there was no asset to transfer. These are greenfield investments. These were startups in Nigeria. So you'll be successful with liberalization, where nobody is taking up any asset. You are building the asset that you eventually transfer to government with your own money. You are likely to achieve more success there. So I'm talking liberalization. I'm talking IPOs. That enables LNG to have a market value that you can go and see. All of the government companies, list them so that they have securitizable value, and our balance sheet will be strengthened. But sell, I'm afraid, no. Now, so talking about sell some, as Teslim has said, if it's a private good, by all means, you can sell. But much of the assets that we are talking about, if we are talking about road rail, or we are talking of energy infrastructure, fiber optics, or power transmission, they are public assets. You can't even sell them if you wish to sell them. So make them efficient the way Saudi has made Aramco efficient. Saudi owns 98 or 95% of Aramco. Who will tell them to sell it? If it's good enough for somebody else to buy, it should be good enough for the country to keep. We cannot exhaust all the issues. I just thought that I should provide such rejoinder, and then let Murphy publish the assets it has captured. We shouldn't be talking about National Asset Register in theory. We do have some assets captured there. and let them take them to the market for valuation, and let's begin to unlock liquidity from them. As simple as that. Thank you very much for the opportunity.
Thank you very much, Dr. Teriba, for the clarity. I mean, very interesting points you raised. That beyond investment climates, we need to highlight investment opportunities. You talked about rail, what rail has done for Brazil and India. You've talked about the need for government to look at capital expenditure with private sector partnerships. So private sector can have some equity in it, and of course we can see long-term infrastructure financing. And also, very interesting, you've talked about liberalization, not selling down assets. And of course, you put a challenge to the Ministry of Finance Incorporated that they should publish their national asset register. So that's for Dr. Armstrong Takan and his team, and hopefully we'll begin to see some momentum there. That's it for the interesting second round of questions. And of course, we'll go to the third round, and to our esteemed panelists, we would implore that you take for your answers, make them concise within 4 minutes each so that we can look at questions. We're going to the Q&A session after this. Thank you very, very much. So for Dr. Okiti, again, you've highlighted the challenge of the power sector, and you said that's one area that can really unlock a lot for the households. But how can the government better manage a socio-economic impacts of the ongoing reforms? We also have the fiscal policy and tax reforms. How can they ensure that this does not exacerbate poverty or inequality in the country? What other areas would you like to highlight in 4 minutes? Thank you.
All right. Thank you so very much, Otto. So let me quickly, perhaps I gave the wrong impression that macro is not important. I'm a macroeconomist. So in the last session, macro is important. But if you look at all our economic analysis in this country, so we tend to focus on all those macro variables. And if we continue to focus on them in the next 10, 20 years, you can actually improve macroeconomic variables, but without actually touching significantly improving the lives of the average Nigerians. And I'm not suggesting macro is not important, but it brings me to 2 issues, which Dr. Tilewa and Dr. Teriba actually explained very well in the last, but let me just encapsulate it like this. There are 2 roles you expect of every fiscal policy. One is the expenditure, yes. But the second one, which does not happen enough, and that is what Dr. Teriba stressed, it does not happen enough, is what I call the policy investment. So policy investment in this case, what I mean by policy investment is that it does not require money per se, but it requires you to put in place the structure, the framework that will invite private investment. So we are not making enough of that. And that is the reason why the average Nigerian life is not being affected. So let's talk about education, for instance. If we are not happy with the structure of education, what kind of reforms is required? But however, if you go to Ministry of Education in Abuja, what they will tell you is they don't have enough money. So they see money as the problem. But money is not the problem in education. Money is not a problem in health. Money is not the problem. It's not the reason we are not attracting investment. Money is not the reason we are not having real development. Money. So it's not government budget. However, for every government official, that is their focus. But that can no longer be my home focus. So I'm not interested in whether it's 55 trillion. I'm interested in the policies that will facilitate private investment. The private investment, that private investment is what will improve productivity and is what will improve growth in the long run. So let me give 2 examples, one by Dr. Tilewa and of course one recently by this government. The telecoms investment that we saw in the last 25 years came on the back of a microeconomic reform, not macro. A micro means it faces the market, is a market reform, and we saw what happened. My expectation is that the removal of subsidy, which is also a micro reform, will have the same impact over the next decade. We are beginning to see some competition in that area now, but that competition is just the start. I expect that other industry, maybe the plastic industry, the petrochemical industry, all those things, I expect that investment will start to happen in that area. So those are the kind of reforms I want to see. In terms of the tax reform, it goes to only demonstrate there's nothing wrong with the tax reform. I'm in support of it, especially because I expect that it will remove some frictions and improve market efficiency. I listened to Taiwo Oyedele, and the one that I'm really hoping will happen is the example of you have 70 roadblock from a yam farm in Benue to Lagos, and the yam, by the time it gets to Lagos, is already 4 times or 5 times the price of what it was in Benue. We can't continue like that. So if the tax reforms help us to deal with that, I'm very happy with that. So, summary, we need reforms. In fact, we don't have enough reforms. But the kind of reforms we need are reforms that remove market frictions, improve market efficiency, attract investment. Those are the objectives. Attract investment, improve productivity. If those reforms are not doing all these things, then it is not a good reform in Nigeria today. What I have seen so far in the last almost 2 years is the obsession with increasing government revenue. That is good, but government revenue is not the only problem in Nigeria economy. You can improve government revenue and you will still not drive up productivity in the economy. So that is my key point. Thank you.
Very much, Dr. Okiti. It's very important that we have reforms that remove market friction, improve market efficiency, attract investments, and improve productivity. And we should not be so fixated on what will improve only government revenue. Thank you very much, Dr. Okiti. To you, Dr. Adebajo, you highlighted the importance of engaging entrepreneurs, the private sector, like the Dangotes and the Adu-Samad Rabius, to drive investment in critical sectors, given the limitations of government capital expenditure. Just like Dr. said, some major capital expenditures, government can do it, they need private sector to be involved with some equity. Do you see this recommendation? Has it been adopted? Do you see some leverage here? And are there public and private sector initiatives that should be scaled or replicated to boost national productivity and improve household resilience?
Thank you very much. I worked for 3 years as a senior technical advisor to the Minister of Industry, Trade and Investment. And within those 3 years, I think we had the largest on record, the largest number of FDIs coming into Nigeria. And there was a combination of reasons why that happened. Most of that money came from local direct investments, i.e. companies that were previously in Nigeria who were expanding. So if you take a look at the foreign direct investment laws in Nigeria, we have probably one of the best laws available. And when you take a look at those laws that are available, then I think we are not exploiting that. I mean, we have tax holidays, repatriation of your profits, everything is there on paper. But once your policy is wrong, then you're going to have challenges. It is also important to understand that if you are going to have a private sector-led economy, and I think that's the mistake we always make when we look at the government budget. We look at the government budget and we think that there's hope there. There's really no hope in government budget. The only part of the government budget that is relevant is the capex of what government is doing, and capex focused towards infrastructure that could create an enabling environment for business to grow. What has stalled government really is policy, coordination of policy between monetary policy, fiscal policy, investment policy, trade policy, and these are things that are issued. And most importantly, industrial policy. We do not have an industrial master plan. If you have an investor that wants to come into Nigeria today and says, we want to invest in pharmaceuticals, We're spending 24 billion in imports from China. So why can we not manufacture some of these things? What is happening to our automobile industry? We had Pan, Volkswagen of Nigeria. Why haven't those industries been sustained? Because adverse economic policies, structural adjustment has deindustrialized Nigeria. So you are now an import-dependent company that does not have significant structures to be able to put value-added manufacturing into your country, even if you start with assembly. So when you do not have an industrial policy, how do you invest? One of the things that I discussed when I was in trade and investment, as we sat down with the likes of the Toyotas and all that, and I said, look, why don't you come here? They said, you have policies and your policies are subject to change. In South Africa, in Port Elizabeth, all the Mercedes-Benz and all the BMWs that are right-hand drive all over the world are manufactured, not assembled, manufactured in South Africa. Right-hand drive vehicles, they had done that. In Nigeria, what they told us was that your policies are too flippant. You somersault, one government comes and says one thing, the other thing says another thing. If you want us to come and invest, we don't need an automotive policy. We need automotive legislation that would not change. So when I talk about enabling environment and an investment climate, it's important that, this is from what I've experienced. We have to ask ourselves where we're going because we're fighting fires. Like I've said, the only positive development I've seen is in the oil and gas industry now with the reforms going on there and cleaning up the investment. But the oil and gas industry used to attract $22 billion a year. Now, last year, maybe the investment was only $3 billion. So now with all these changes and things going on, we're beginning to see that people are going to begin to ramp up investment in that sector. By the time investment in the oil and gas sector goes from 22 billion to 2 billion, you can see it. Our rig count has dropped to about 15. Our rig count has dropped to 15. So when you have rigs, so what about light manufacturing? Simple things like we prepare, and what sort of companies are coming in? What is the quality of the products that you see coming into Nigeria? We're bringing fake products here now. So we need you have the Standards Organization of Nigeria, you have all these, what are they doing? So the Trade, Industry and Investment Ministry is critical to restore Nigeria's productivity. Because if we can't continue, this government has coming now, there's been another government, 8 years of Buhari, we now have all these situations now. We can't continue to firefight. We need to have some sort of stability and we need to understand what sort of industries are closing while other types of industries are coming back in, other industries are closing. And even the established industries, the multinationals are having challenges here that they are now ceding to other third parties to come and run their businesses or contract other third parties to run their businesses for them in Nigeria who have a better understanding of the business environment because they have high corporate governance standards that they need to appeal to. Most of these companies, you want to import things, people are importing things and there's no level playing field when it comes to importation. If you import and pay all the right duties and taxes in this country, it's likely you're going to make any money. But a lot of companies know how to bypass that system and so there's not a level playing field. So we need to look at our tariff structures. We need to look at our HS codes. Industry policy, trade policy, very critical. We minimize trade policy. Trade policy is critical. That's why I mentioned all the HS codes. We need to review all those tariffs and understand that, you need to create the incentives for industry to come back into Nigeria. And it's from industry you create employment. Now they're telling us that unemployment is 4%, but we all know that employment in Nigeria is not 4%. because of the rebasing. Employment now, if you work 1 hour a week, you are considered employed. So we need to step back a little bit and understand that, because we have just been fighting fires. We've not been able to break out of stagflation in the last 10 years. And it's important that we sit back and put the right things in place and do it properly. Like, you know, nobody was against the removal of subsidy, but the way and manner that it was done was not the best. The cart was put before the horse, and we saw some significant distortions. Where does your exchange rate move from 500 to 1,700 within 6 months? You know, in the last 30 years, the variation between the British pound and the US dollar or any other major currency in the world has not been that high. These are major shocks that, you know, it's going to take us time to recover from. So it's time for us to sit back and I think to relook at policy that will spur growth and sustain growth and development and encourage investments into this country. And that comes with the coordination of monetary policy, fiscal policy, trade, industrial, and investment policies. So it needs to be deliberate. I think we've all seen one video that went viral about some minister in India talking about Modi's policies, that they were deliberate. It wasn't an accident. They were very deliberate in what they were doing. So let's hope that with what is going on in the oil and gas industry, we can revive it, get the investment back to the $22 billion a year level that it was before, and then begin to increase our oil production, get foreign exchange reserves up, proper reserves, not net reserves, and build up our reserves, build up our foreign exchange base, and begin to put in things that could have sustained growth and development for Nigeria. Thank you.
Thank you, Dr. Adebajo. I mean, you've really highlighted the need for the Federal Ministry of Industry, Trade and Investment to play a very critical role in restoring national productivity, the opportunities to fashion out our trade policy, which will look at review of tariffs and HS codes, very important, and the National Industrial Master Plan, very important. We need to restore growth and productivity. To our participants, if you have questions or comments, please send them to our chat box and we would attend to them shortly. So to you, Mr. Shitta-Bey, from a fiscal policy advisory position, that's where we're putting you at this point, just for this moment, what are the policy reforms in areas of reducing fiscal deficit? I know you've talked about building reserves, so we won't want to overflog that, and curtailing the cost of governance, reducing fiscal deficit and curtailing the cost of governance.
Thank you, Otto. I will answer that, but just before I get to that, I want to thank the other discussants for highlighting the importance of household productivity. That is crucial in resolving the economic challenges we face currently. The household is central to ensuring that Nigeria's economy grows sustainably. We've got to look for ways of improving the circumstances of the household so that the productivity or the marginal product per person in the household improves. Now, I want to quickly also cross over to what Dr. Okiti talked about when he talked about education, and this is very crucial. Do we have a fit-for-purpose educational system? The educational system that leans into tomorrow rather than yesterday. Because if we don't, the household will be under severe pressure there again, because we've got to have an educational system like they're doing in Kenya now, revising the curriculum in such a way that they're looking at fitting the individual student into the economy they see tomorrow, such as AI augmented work environments. You know, we've got to take a deliberate approach. And I think it was Dr. Adebajo who was talking about deliberateness. We've got to take a deliberate approach to looking at the future and reimagining that future rather than resting in the ideas we had of yesterday. The Nigerian economy of today is different from that of yesterday and will continue to evolve. And we also must take policy stances that evolve with that change. those are points I said I should quickly make. Then I also want to put in this issue. I think is Dr. Tilewa was talking about the gaps in all these policies in terms of industrial, monetary, fiscal. Proshare has a concept of the hexagon of power. And for us, the economy as it is today can be put in a hexagon where we have key sectors that exist, but can be compressed into sub-economies. And we've identified of the 46 sectors that exist, we've identified 14 that they can be compressed into 14 sub-economies. And these 14 sub-economies can be targeted in such a way as to improve overall national productivity. And I think that's one of the ways to go. I agree with Dr. Adebajo that industrial policy is critical. I agree also fiscal, monetary, tax policies, all kinds of policies. But there must be a coherence. There must be an integration of all these policies such that we have what we call a whole of government approach to resolving issues. Currently, what we're seeing are great policies that are implemented in silos. We've got to go beyond silos to integrate policies such that we try to achieve specific goals that everybody knows that these are our goals and this is the way we want to get there. I looked at the first poll that we did at the beginning of this session, and 50% of the respondents talked about plans, the absence of plans. It may not so much be the absence of plans, but it's basically the absence of integrating those plans into the day-to-day realities of the household. People need to align with those plans, need to understand where their role is in those plans, whether you're private sector or public sector. You've got to have a clear understanding of where we are going and how we intend to get there. Now, let me address quickly the issue that you talked about when you talked about fiscal policy. Now, we need to be a bit careful here. I agree totally with those who have argued that our fiscal deficit is large. I agree with that totally. I agree with those who feel that our debt service ratio to revenue is pretty high. That is true. But I also argue that we could actually drive a bigger budget. We could improve our budget performance if we adopt some of the strategies that have been discussed here today. If we can, for instance, have a deal room. Dr. Teriba, I think it was telling us about the deal rooms that you have in India, Brazil. Nigeria can have a deal room, create deal rooms. I think it will take maybe 3 to 6 months of a few of our national assets that are idle to be listed within the context of a deal room, where we look for investors to come in and bring this money we're looking for in. Now, with the inflow of that money into the system, the government perhaps will not need to use its tax resources to fund some of these projects, especially capital projects. One of the problems, I hear Dr. Adebajo talking about the necessary intervention of the public sector in capital expenditure. I am not saying that isn't correct. However, I'm saying that to augment that, we could get private capital into the system to fund those capital requirements, railroads, superhighways, a couple of other electricity infrastructure and transmission infrastructure. All these things can attract private sector investment. And if that is the case, I feel that that's what needs to be done at this moment. Cutting back on budgets, yes. Should we set up a Department of Government Efficiency as they have done in the United States of America? I'm not too certain about that, but it could be a way out where we look at inefficiencies within the system, where we begin to ask ourselves, could we cut back fat in certain areas? Maybe that could be part of the solution. However, for me, I think that, and for my team in Proshare, we think that one of the greatest things we could do is to first and foremost assess the assets that we have within the system and see how we can put those assets in a format that enables private sector investment, both local and foreign. As we speak today, there's no public sector entity that is listed on the NGX. So we can't even establish values for any of the assets that the federal government owns. And when I say federal government, I'm also including subnationals such as state governments. There are no of their assets that are listed on any exchange. So we cannot establish market value, and therefore they are not tradable on any floor. And therefore, even if we said, okay, you know what, we're not going to sell these assets, but we are going to use the equity value in those assets to generate income, we cannot, because there's no market value. So the argument for me is that we need to optimize our assets and use the assets as a means of funding our capital requirements, rather than depending on just the public sector to do that. Does the public sector have a role? Yes, it does have a role. Creating the right environment. Now, I agree with Dr. Teriba, and when I say the right environment is an environment of incentives. I'm talking about the government provides an incentive to ensure that investors find Nigeria attractive enough to bring their equity capital. We have countries in the world that are either on the brink of war or perhaps they are at levels of internal resurrection, and there's still investments going on there. Because, for instance, I can securitize a pipeline. It has nothing to do with the country rating. It's the stream of cash flows I can generate from that pipeline that is important to me, and the inherent risk in that pipeline being blown. If there's a minimal risk of that pipeline being blown, and if I'm sure that the stream of gas or oil that goes through that pipeline is assured for the next 20 years, I perhaps would invest in it. Now, what my expected market return will be is a different issue entirely, but the market return will be such that will compensate me for the risk. As Dr. Teriba, I think, is the one that emphasized that. So for me, the public sector needs to trim, but I'm not certain that it's going to be such that it's going to have massive impact on Nigeria's development and growth. I think let's go private sector. Let's see how we can securitize and financialize public assets so that we can generate investor interest domestically and internationally to block those gaps that we have talked about. Thank you, Otto.
You should go private. That's public-private partnership, where you can securitize assets and unlock liquidity for the economy. Of course, you've highlighted various issues, and all of them just revolve around our ability to unlock value for the economy. So, Dr. Teriba, for this last round of questions, and hopefully in 3 minutes, if you could just look at this issue around subsidies. You mentioned that subsidies cannot be eradicated, but should be restructured from price subsidies to income or expenditure subsidies to support vulnerable households. Where are we using subsidies as incentives to grow key sectors? And how can we ensure that such reforms do not exacerbate poverty and inequality in the short to medium term?
Yes, thank you very much. About time we listen to questions, from the audience. So, as you say, I will be brief. Yeah, a year ago I recalled, saying that the debate about whether subsidies should be removed or not removed was the wrong one. That price subsidies are inefficient, they are distorting, and that there should be no debate. Price subsidies should go, whether on petroleum products or exchange rate or gas or power. But that doesn't mean that subsidies should go. The government will need to protect the vulnerable. So let the market price allocate resources and reward investors efficiently. But let government now decide how many people are vulnerable and wants to transfer, money to them so that they can access it. Well, you now have a Ministry of Humanitarian Affairs that is meant to do, well, the Buhari regime had done a lot of that, but they were trying to rev it up under this. But the challenge is still the institutional capacity and the transparency to carry it out, knowing that a minister's head has already ruled for diverting those monies that were meant to go and subsidize the poor into non-poor, accounts. So the challenge of implementing is there. The World Bank is ever too ready to give you loans, with which to subsidize. But perhaps the lesson of the last 1 year is that, see, much of the erosion of the welfare of Nigerians and much of the pressure on prices are coming from weak exchange rate. So why doesn't World Bank, IMF support the government to build up the reserves and strengthen the naira? Because you want to give 75,000 to 70 million Nigerians to show up, income erosion by devaluation, and devaluation will still wipe off that your 75 billion. So why don't you just show up the naira and all Nigerians get implicit subsidies from the strength of the exchange rate? So in closing, I would just like to reiterate that Nigeria's problem about taking our assets to the market is, the saying that instead of you chasing butterflies, why don't you have a garden and butterflies come to the garden? Where the carcass is, there the vultures will be gathered. So in terms of investment projects, investment opportunities, let Nigeria show us the carcass that it is expecting investors to come and swarm around. And if we are sure that the carcass is truly there, you will find that investment will show up, as they did in Saudi, in Brazil, in India. Nigeria is no exception. And as they did with our LNG and our GSM. The second point, as I close, is that much of the assets that will make a difference to Nigeria's progress, especially in the infrastructure space, are owned by the country. They're sovereign assets. And that taking them to, you can't sell them. You can't sell rail. You can't sell your airports. You can't sell. Taking them to the market, and having some sense of the market value for those assets will help our ability to raise long-term financing or equity financing in terms of public-private partnership, or build, operate, and transfer modalities on them. And finally, the lessons we have learned from monetary policy in the wake of the extreme tightening, of monetary policy in the last 1 year that has produced very little result, is that the impossible trinity is at issue. The policy trilemma is at issue, and the impossible trinity. Unless you have reserve adequacy, you'll be tightening, it will be futile to be tightening monetary policy levers, because those monetary policy instruments will not be effective in achieving stability. So I hope that the Monetary Policy Committee has learned that lesson in the last 1 year, and that henceforth they will put as much effort on country Nigeria, of which they are an agent, to build up reserves as they are putting on banks to recapitalize. Because it's futile for banks to recapitalize if weak reserves is going to mean that exchange rate devaluation will erode this capital base anyway. So it's more important that Nigeria's reserves be solid, so that monetary policy instrument can be effective and the exchange rate can be stable and inflation can come down. Thank you very much. Moderator.
Conversation, and we want to move quickly to the question and answer session. I would like to invite our participants to our third poll quickly before we take few questions that we have on the chat box. Thank you to all our participants who sent in their questions and comments. which has made the conference engaging. So let us begin with the first question, anonymous, but this question will go to Dr. Teriba. Just in 1 minute, he said, how well can the 774 local government areas impact on the 55 trillion naira 2025 budget? What's the role of local governments in this regard? Doctor, just your response in a minute.
Well, just to say that the 55 trillion budget is the budget of the federal government. That each state and each local government has their own budget. Because, you know, revenue in the federation account are distributed partly to federal government, to states, and to local governments. And each of the three levels also have their own internally generated revenue. So there is no connection between what the federal government is spending and what local governments are contributing. So we have to go and look at what is local governments don't read budgets that are announced in newspapers, but they do have their own budget. So state governments read budgets that are published, and federal government has its own. In the past, states used to spend just as much as the federal. But in more recent times, that federal government borrows, you know, the borrowing capacity of the federal government is far in excess of the borrowing capacity of states. States' budget, collective budgets have become a fraction, at least the announced budget has become a fraction of federal government's announced budget. Although, if you go and look at actual firing power, you may still find that federal and state still spend the same thing, you know, after the fact. Local governments spend much less than them. So we should not ask questions about local government in conversations about federal budget. Thank you.
Thank you, Doctor. This one will go to Dr. Ogho Okiti. Your response, please, in 1 minute. What sustainable programs will help solve the economic challenges of households in the short, mid, and long term?
Sustainable programs. I mean, genuine reforms that improve productivity growth will solve household problems. But so that is, I mean, there are many of them, but genuine reforms around investments, around improving the business climate, improving job opportunities, improving education and health outcomes, all these, any kind of reforms along these lines will improve household situation in the country. And that is when you can really begin to see impact of government. And like I said before, these reforms are not necessarily about increasing government expenditure. They are about thinking about the necessary policies and reforms that will galvanize the private sector to deliver the productivity growth that we need. And of course, that will deliver productivity, increase in the productivity in income and everything. So it is those kind of reforms that we need to work on extensively. Policy reforms are not necessarily about throwing money. I mean, you just, we budget, because we all know the reason they are fighting over the budget is because it does not concern me, and you know what I mean. So policy reforms, yes, thank you.
Thank you, Dr. Okiti. For Dr. Adebajo, there's a question, again, anonymous. What should be the role of subnationals in our drive to increase productivity and ease pressure on households? For 1 minute. Sorry, that was from Akim. Yeah, Akim.
Thank you very much. First of all, I think one of the things I also learned when I was working as a senior technical advisor to the Minister of Industry, Trade and Investment is that whenever you go on an investment drive, the federal government of Nigeria does not have any land. Any activity that takes place at the subnational level. So if a company wants to come to invest in Nigeria, it has to go to a state. So eventually, it is that state government that is going to allocate the land, that is going to provide the employment, provide the workforce that will help, this industry and this companies survive. So I think that is something we also need to take into serious consideration, because we tend to understate the role of the subnationals and the local governments. And I think, as Dr. Teriba has said, the budget looking at 49 trillion is only that of the federal government. So by the time you add the 36 states budget to the total government expenditure in the country, it's pretty significant. So everything happens at the subnational level. And I think it's important that they need to also begin to bear this burden, and the government needs to take them into consideration to understand, to ensure that those policies are being supported properly, especially in the areas of double taxation, whereby local governments can become unnecessarily aggressive. So yes, without a doubt, the subnationals and the local governments are where the action takes place, and it's where the Nigerians live. Thank you.
Thank you, Dr. Adebajo. Hakim's second question was around a roadmap to a $1 trillion economy, but of course, our conversation today has highlighted the need for coordinated policies. So that has already been answered. But the last question, of course, I think it's anonymous, is to Mr. Teslim. Does the capital market has any role to play in navigating the current state of the Nigerian economy and household reality? In 1 minute, Mr. Teslim Shitta-Bey.
Thank you, Otto. That's an interesting question. Yes, the capital market certainly has a major role to play in navigating the Nigerian economy. In Proshare, we've written a report very recently on the national, I would call it the NCM, the National Capital Market Report. One of the things we highlighted there was that there was no alignment between government's policies and the capital market. For instance, I had said earlier that there is no public sector enterprise listed on the NGX. We have also discussed during this session that it is important for the government to financialize and securitize assets. So what does that mean outside the big grammar? It's basically this. The government identifies certain assets. It creates a deal room or a place where investors can go and look at those assets and do some tire kicking. Tire kicking meaning that we evaluate these assets. Like Dr. Teriba had said earlier, where you have refuse, that's where you see a swarm of birds, vultures coming around to see what they can peck on. That's exactly what we're talking about. Create that environment where investors can come, see what they can do with what you have, and perhaps turn it into some kind of sustainable value. That's what the capital market does. It creates the opportunity for both private sector and public sector entities to come and sell or to trade assets. So yes, the capital market certainly has a critical role to play in navigating the Nigerian economy and driving it towards the $1 trillion economy we expect by 2030. Thank you, Otto.
Thank you very much to our panelists. Once again, I want to thank those that sent in questions and, of course, comments. And for those that send in later, of course, we would attend to them, send them to research@proshare.co. Thank you very much. I want to thank Dr. Ayo Teriba, CEO of Economic Associates, Dr. Tilewa Adebajo, CEO of the CFG Advisory, Dr. Ogho Okiti, CEO of ThinkBusiness Africa, and of course, Mr. Teslim Shitta-Bey, the Director of Research and Chief Economist of Proshare, for being part of this very robust conversation on navigating the Nigerian economy and household realities, policies, programs, and projects. It was a very, very interesting conversation, and we really thank you for this very robust session. In the next 10 seconds, we'll invite you to our last and final poll. That's the fourth one, the last poll. Thank you very much. I would now like to invite our Head of Business and Markets, Jumoke Adeye, to give the closing remarks.
Okay, thank you very much, Dr. Abasi. I want to thank our panelists who have made this conference engaging and insightful. We also like to thank our participants who joined virtually to participate, especially those who sent in their questions and comments. We appreciate you all. We implore you all to visit our website and follow us on our social media platforms to get more updates on our economic reports, articles, and take it again, research@proshare.co. Earlier on, I heard somebody ask a question about subnationals. Well, this is to inform all participants that tomorrow, on Tuesday, February 18, 2025, we will be hosting another edition of the Art Fact program by 10 a.m. And thank you. We've ended this conference. We thank all the participants and our esteemed speakers for making it worthwhile. Thank you once again and have a lovely day. Bye.